Hi, everyone. Thanks for joining our program. I'm your host, Jason Nadek. It's no secret some Canadians wait until the filing deadline draws near before thinking about their tax situation. Take a survey done by IG Wealth Management from April 2022. For example, fewer than 1 in 5 respondents described tax planning as a year round activity. Well, that procrastination can potentially cost them a pretty penny. There are several ways to help lower the amount of taxes we owe using our investment portfolios, but some must be implemented before the end of the calendar year. So, a little planning and foresight is required to ensure we aren't leaving money on the table. Let's explore some of the many tax considerations available and savings we can potentially find. Here with us is Nicole Ewing. She's the Director of Tax and Estate Planning with TD Wealth. Nicole, nice to see you here today.
Thank you, Jason. Delighted.
For the audience's benefit, can you give us a little peek behind the curtain of what you do with TD?
Sure. So I'm a lawyer by background, and I've worked in tax, estate, business succession and planning for my career. And with TD, I'm the primary voice of our tax, estate, and insurance planning group, and I work with our ultra high net worth clients when we're developing complex solutions for them.
It's a very interesting background, and I'm sure there's lots of great details for us to pull out here in our conversation. So let's get started. First off, what are some of the key considerations to keep in mind when it comes to managing taxes on our investment portfolios throughout the year?
Okay, so we're going to start with the big caveat, right? We don't want taxes to wag the dog. We have to make sure that tax is a consideration, but it's not the only consideration. So when we're thinking about what works best for us, we want to keep that in mind that tax is an element, but not the only thing to be thinking about. And as you mentioned, we also want to make sure that this is not a panic at the end of the year, just a year-end thing that we're thinking about. We really want to have in our minds throughout the year, sort of back of our minds, what is our overall sort of plan for what we're going to be filing next year. So we want to be thinking, is there things I can be doing maybe in January, February, March, April to make that ultimate year-end planning a little bit easier? And one of the things I think is really crucial there is making sure that you keep records, that you know you're in a position to be able to produce documentation to justify the way that you're filing in the following year.
That makes a lot of sense. And when we're talking about an investment plan, we're often talking about it's not a set it and forget it type of strategy, and tax planning is certainly part of that as well. And I guess further to the point that you're making, it can sometimes be a hassle to keep our tax records and documentation in order throughout the year. Do you have any suggestions that you can share with the audience to help with that?
Well, I think starting with keeping in mind that the bigger hassle is if you are asked to justify your position by CRA and you have a timeline of a month or even 2 weeks to produce that documentation. So we want to be keeping that in the back of our minds always, that the little bit of effort that we can put in throughout the year may save us from a whole bunch of headaches and perhaps a loss of the tax benefits in the future if we're not able to produce them. So I would say let's not let perfect be the enemy of the good. Let's make sure that we're doing what we can. If we can't be perfect, that's okay. Let's just take the steps that we can to, ensure that we're in the best position that we can. And some people will do this weekly. Some people will do it monthly. I like to think of the day for future me, and doing something now that will make future me very pleased with myself. And so setting aside that time once a month, maybe look at what I need to put in place. And there are so many different ways of doing this. I would suggest that if you're finding it challenging to keep all of your records organized, then look for a different method, because there's lots of people that can't stand working with the software that might be out there, and they just love their good old-fashioned Excel spreadsheets where they can document everything. So ultimately we really want to be just using what works best for you. And then if there's different types of assets that we might have, we might want to think about them a little bit differently. So crypto, for example, can be very challenging to keep appropriate records, and there's specialized software that would allow you to be able to do that more efficiently. If, for example, you have a rental property or a cottage and you want to be claiming some of those expenses on your taxes, maybe having a separate account for those assets and having all of the expenses flowing through that account. So it's easier for you to pull those statements, hopefully every month, but at least at the end of the year to be able to have those documents ready for you.
Asked to justify seems very friendly, and it might not feel that way if you are in fact being audited, but some of that preparation can really help remove some of the stress
Yeah.
of that situation. There are many approaches an investor could take to help lower their taxes, far more than we have time to cover here. So let's touch on a handful for investors to consider. Along the way, we'll use some examples to illustrate the potential tax impact. The first consideration is tax loss selling. What is that, and how does it work?
Yeah, so essentially, tax loss selling is where we unfortunately accept that this investment is has lost value, and we don't think it's necessarily going to increase, and so we crystallize that loss, and we essentially our investment is has a lower fair market value than it does cost, and so that would typically be a loss. But we also have investments where we have gains, we have capital gains, and so we have the opportunity to offset some of those gains with our losses to reduce our overall tax payable.
What are some of the factors to keep in mind when tax loss selling?
We always want to look at our overall investment strategy first. This is paramount. So we don't want to be simply because we have a loss, knee jerk thinking we needed to be engaging in tax loss harvesting. We want to look at our overall portfolio and make sure that the investment decisions that we're making still make sense. And so if it's in, for example, a registered account. Clearly, we cannot do our tax loss selling from a registered account because we don't have those losses. We're not paying tax on an ongoing basis in our TFSAs and RSPs. So if we trigger a loss, it's not a taxable event in that sense. And so we can't offset our gains. We want to be sure that we're thinking really only in our non-registered accounts, so we can affect this strategy. And with our tax loss harvesting, we have the ability to bring that loss back 3 years or carry it forward into the future to offset against future gains. So again, we're always looking at sort of a multi-year strategy. We don't look at things in a vacuum, and we might want to think, what position will I be in this year and next year, and perhaps even the last few years, and can I do some coordination to reduce that overall tax bill? We want to also think about coordinating things with the other people that we might be filing with. This is sometimes lost that, for tax purposes, we are connected to other people in our life. So we're connected to our spouse, to our children, but perhaps other people that we might not even be thinking about. So certainly any corporation that we have, that private corporation might be on the radar. But sometimes we miss the like trusts, for example. If I'm a beneficiary of a trust and it's a discretionary trust and there's other beneficiaries of that trust, the rules may say that each one of us is deemed to own all of the shares of that private corporation. And as a result, we'll end up being sort of associated with other taxpayers. And so when we're thinking of something like tax loss selling, if we have the superficial loss, it's the previous 30 days and the post 30 days of a purchase and sale that we want to be thinking about. And if we trigger a superficial loss by selling our asset at a loss and then repurchasing that same asset within that 30 days, our loss is going to be denied. It will be ultimately added to the cost base of the new shares that we acquire, but it's going to be denied. It will also be denied if any of those associated people also have purchased or sold that. So our spouse, corporation, doesn't matter which account it's in. So you're, non-registered and registered. We need to be thinking of that really in a big picture.
Excellent information. I'm glad you took the time to clarify that for the audience. And and also one thing as well is when we're getting into like complicated personal tax situations where we've got corporations as well as trusts or other entities, making sure that you're speaking with your qualified tax professional to ensure that you're on the right track.
We want to coordinate our planning because your accountant may have things that they're thinking about doing. So, for example, with the capital dividend account, they might be treating that a certain way. And if you're doing something in your investments that might undermine that because you don't know that there's something else that's being planned for you, you can inadvertently undermine all of the planning that's being done. And so having, everybody on the same page about what you're trying to achieve, what your overall goals are, and then you're making decisions consistent with that. Your accountant is making decisions, your lawyer, and perhaps anybody else that you're working with is all coordinated to ensure that we're not, inadvertently losing out on some of those possible benefits.
Of course, there are any number of factors that could affect an investor's tax situation, but can you walk us through a simplified example of a potential benefit of tax loss selling?
So think of an example here. If I had earned a capital gain of $20,000, so 10,000 of that is going to be taxable, right? That's our taxable capital gain. It's 50% inclusion rate. And let's say that I'm in a 35% tax bracket. That would mean that I would have a taxes owing on that gain of about $3,500. Now, if at the same time, I have another investment that's doing poorly, and originally, it's down $10,000 as well, we want to, and I sell that, so I have a capital loss of 10,000, but an allowable capital loss of 50%. So the same way that we have 50% of the gain, we have 50% of the loss. And I'm then able to offset my $5,000 loss against the $10,000 gain, ultimately splitting my $3,500 tax bill in half. So I'm now responsible for $1,750 as opposed to the $3,500 of tax. So it's essentially we are reducing the amount of income upon which tax is payable.
A reminder to our audience that the examples we're sharing are simplified to help us understand the principle of these tax considerations and how they might work. However, tax rules and tax brackets are subject to change. So visit the Canada Revenue Agency's website to get a more in depth understanding. Next consideration is deferring realization of capital gains on investments you intend to sell. So, how does this work and what's the potential upside?
So again, and you'll recognize a theme that we're thinking about looking at our tax situation over multiple years. And so when we think about when we're going to trigger the gain, we want to look at the other income that we have and say, does it make sense for me to trigger this now? Or may there be a benefit to me waiting until January, for example, to trigger that gain so that it's included on next year's income as opposed to this year's income? And lots of reasons why we might want to play with our income a little bit. So maybe I'm going to be going on paternity leave. Maybe I know that I'm a freelancer and my income is going to be less next year. I want to, think about what I'm going to be including in my income this year and next. So we're going to take 2 years, for example. Very, very simple example. And to reiterate your point, there are so many considerations that we want to make sure that we're not just letting tax wag the dog again. But if in this example, for example, my taxable income this year is $100,000, but I know that next year my taxable income is going to be $60,000. And I have the choice of whether or not I'm going to declare a gain. If I were to have, for example, a $40,000 gain, 20,000 of which of course is included, that's my taxable capital gain, and I have the choice about whether to have that this year, so I have $120,000 of income and 60,000 next year, versus dividing that into next year and having $100,000 of income this year and 80,000 of income next year. I think if we do the math and pull it out, we'd pay $2,730 less in tax if we deferred that gain to the following year. We think about that in just very simple terms about our tax brackets. And when we bump up into a higher tax bracket, we might be going into a bracket that is going to be, ultimately we're paying tax at a much higher rate than we would on that same income if we were in that lower rate. Of course, we'd look at the different types of income that you're bringing in, some of the considerations about why we would not want to have additional income, for different sorts of government benefits. All of this has to go into thinking about whether this makes sense for you.
Course, and all that preparation that we've talked about earlier, and that foresight that we're advocating for, that can help determine if this is a worthwhile consideration for you. And again, check out the Canada Revenue Agency's website for a detailed breakdown of how capital gains and losses are calculated, and so that you can apply that to your own specific situation. Okay, so there's a similar dynamic to consider with RRSPs, which brings us to our next consideration. An investor could choose to defer claiming their RRSP contributions until the following year. How might this help them pay less in tax?
Yeah, well, and this is something, again, we're looking at our multi-year, but something that people don't necessarily realize is that the contribution that you're making can be separated from when you claim that deduction. So I can make a contribution to my RSP this year and not claim that deduction. And I might do that if I think I'm going to have, substantially higher income next year or in future years than I have right now. So there's sort of examples that we can think about, but it's not an all or nothing. I'll say that. So we can either claim the full amount now, we can claim the full amount in a future year, we can choose to take as much of the deduction as makes sense to sort of maximize that tax benefit that we're getting.
Can you walk us through an example of when deferring a portion of RRSP contributions might make sense?
Course, we want to make sure that we think about this in terms of our tax brackets that we're in and what is our marginal rate, what tax rate will apply to our next dollar earned. So we always sort of want to think in those terms. So when we're looking at whether it makes sense to defer a portion of your RSP contribution, the deduction that you receive from that, we're really trying to figure out where does it make sense to pull down our income to below a certain threshold versus using everything that we possibly can. And so if we sort of walk through an example, I'm thinking here of the $52,000 sort of income rate because there's a stark difference. We can see sort of under that amount, we'd be paying tax at 24.15%, and over that amount, we're paying tax at 29.65% in 2022. So there would be a motivation, say, to reduce the income that we have to just below that threshold, hopefully, and that's where we're really going to maximize our benefit. So if we look at this over a 2-year period, and we say that an individual has income of at $55,000, would it make sense for them to sort of use all of the $10,000 contribution that they had made to reduce their income to, say, $45,000? Or does it make sense for them to use, $5,000 this year, sort of get below that $52,000 mark, and do the same thing in the following year? And when we work through the math of that, if we were to split the deduction over a 2-year period, so in year one we have $50,000 of income because we've used $5,000 of our deduction, we'll end up owing $20,359 of tax over that 2-year period. Instead, if we were to say, forget it, I'm taking the full amount this year, I don't care about next year, I'm going to take it all into, I'll take my full deduction, so I have $45,000 of income this year, and next year, be what it may, I will have paid tax of $20,673. So by splitting it over the 2-year period and getting the benefit of reducing my income over 2 years instead of taking full deduction 1 year and none the next, we have a $315 savings of tax over that 2-year period. Now, what's $315 worth? That will depend on you, of course, and your particular circumstances. There's other things to think about from when we're manipulating our income up and down. There may be things like government benefits, for example, that are income tested that might be impacted by what our income is. And so we want to kind of think, well, if by claiming this deduction, I'm now eligible for this other benefit that is worth much more than the $300, it may in fact make sense, to kind of do some of that math as well. One thing I always like to have folks consider is the opportunity cost. So if you have put in, if you're claiming your deduction and you're getting a refund from that, you have the opportunity to invest those funds as well in the following year and potentially make good income on those funds as well. So a lot to think about, but it's ultimately going to be a question of math.
Lots of considerations to take into account when you're planning for this year and for future tax filings. Absolutely. And just like the other examples that we've discussed, everyone's specific tax situation is unique. So consider consulting with a tax professional or visiting the CRA's website before making any decisions about deferring RRSP deductions if you're unsure of what might work for you. All right, so speaking of RRSPs, another consideration we'll mention is income splitting with your spouse. How does this work, and how can this help lower taxes in some cases?
Generally, between spouses, we cannot simply gift money back and forth to have income taxed in one spouse's hands versus the other. Like typically, if I were to gift my spouse money and they invested that, in a property or an investment account, the income or the gain would be attributed back to me because I'm the spouse. But there are certain ways that the government has allowed us to split income. One of those ways is with our TFSAs, where we can gift money to our spouse to be able to contribute to their own TFSA. And the reason that the attribution doesn't apply here, of course, is because there's no taxable income to attribute. And so we can invest in our spouse can take their money into their TFSA and carry on. The other way is with a spousal RRSP. And this is something that we want to give consideration to, that this allows me to get income into the hands of my spouse for their retirement by making a spousal contribution to an RSP for their benefit. Now, of course, it's using my room, it's using my contribution room, and so I have to have enough to be able to do that. But it can be a very effective strategy for spouses to utilize, and perhaps we can walk through an example for that as well. So I'm thinking here of an individual who themselves is over age 71. So of course we can contribute to our RRSPs until we have to convert into a RIF at the year 71, but doesn't say we can't contribute past that. And so if we have individuals who, if there's a difference between their spouse's ages and their own, they may be over age 71, but they are able to contribute to their spouse's RRSP, even though they wouldn't be able to contribute to one of their own. And that ultimately then they can get the deduction for that against their own income, and the RSP income, which will eventually be the RIF, gets into the hands of the lower income earning spouse, so that hopefully in retirement there's a bit more of a balance between their incomes and we can get the benefit of those lower tax rates.
Next consideration is rebalancing a non-registered portfolio ahead of year-end income distribution. What's the potential benefit here?
Yeah, so some funds distribute in December, and we want to always keep in mind that the manner in which we receive those funds can have different tax results. So we can have, interest, dividend income, capital gains income, and how that all falls into your year-end income can have significant impact. So if we have the opportunity to, for example, get into a different type of investment and avoid that year-end distribution, we then avoid that additional income that might be coming when you don't intend it to.
Talked a lot about forethought and planning. Well, here's an opportunity to maybe go back and look to see how those securities have in your possession have paid out their distributions in past years, so you're prepared to enact accordingly this year.
Yeah,
Right. So
exactly.
now, since the holiday season is near, why don't we throw in a bonus consideration that involves the spirit of giving, and that's donating stocks to a registered charity? Why can this both be a savvy tax move and a thoughtful gesture?
Well, it's a very, very effective strategy. As we know, when we make a donation to a charity, we get our charitable tax receipt. What And that's what we would receive if we gave cash. But we have the opportunity to donate instead securities with accrued gains on those. These are publicly traded securities, of course. It's just we have to be mindful that there are qualifying securities to exercise this strategy. But if we have a gain on any of those, if we instead gift to our charity in kind and we transfer those securities to them, we actually don't have to pay tax on that gain. So if, for example, we had, a gain of $100, we don't have to pay that tax on that $100 because we've given that security to charity. We also then still receive the full value of the donation. So it's not lessened simply because we're getting that better tax result. If the fair market value of the donation today was $100,000 and we have a cost base of $20,000, we've got this $80,000 of gain. 40,000 of which is a taxable capital gain. If we're taxing that at, say, 50%, we're paying tax of $20,000. In that same example, if instead of giving cash, we had given the security, we wipe out the gain on that security, we're going to be in a position where we're able to make that same gift for a cost of $71,000 as opposed to $91,000. So this allows you to either make additional gifts using that extra $20,000 sort of found money, or to be able to really maximize the value of the gift that you're able to make.
And one last reminder that you can find all of the rules around donating securities on the CRA's website. So make sure to check out that if you're considering making a gift this holiday season. All right, so we're going to have to wrap our discussion here. Nicole, thank you so much for being here to sharing some of these tax saving strategies with us. I'm sure our viewers are already thinking of how your suggestions might apply to their own particular tax situations. Of course, everyone's circumstances are unique and there are so many factors at play. So consider speaking with a tax professional if you have any questions at all. And now, Nicole, do you have any final words for those watching when it comes to tax planning and tax planning strategies?
Well, I think we want to ensure that we're availing ourselves of all the opportunities. So if that last strategy sounded really good to you, but you think, I don't know, I haven't made up my decisions about where I want to give, we don't need to rush it. We can make a donation to the Private Giving Foundation, for example, at TD through a donor advised fund. We can get our receipts back and we can make our charitable decisions in a future year. So we're able to separate the tax consequence from the giving. So there's always solutions, whatever it is you're trying to achieve, and making sure that you seek out that information so that you can make the best decision for yourself.
So thanks again for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. We'll see you all next time.